My name is Jake, welcome to the channel. In today's video, I want to talk about dividend growth ETFs in VIG and DGRO. In today's video, we're going to take a look at these two ETFs from really a pragmatic and objective point of view and not an emotional point of view. So that's really what we're going to talk about in today's video. Before we dive into that, what you're looking at here on your screen, this is a picture of an airplane. So my wife and I, we've spent the last couple of weeks here in Germany. If you're watching this video today, July 24th, a couple of things. We've just got back from our trip that week, and July 24th is actually my birthday. So I'm, 36 now? Yeah, while my wife and I were traveling, I wanted to make sure that I pre-recorded these videos so that I didn't go 2 or 3 weeks without recording a video here on YouTube. So this week, when you're watching this video, a couple of things, we're just returning back. So the next week, I will be recording a video on a normal schedule here in Austin, Texas, where my wife and I live. And yeah, all that fun stuff. So, but yeah, we've been back in the States for about 5 years. We used to live in Germany, and I'm excited to go back. I'm excited to see all the cliches, driving on the Autobahn and all of that fun stuff. Oh man, it's probably, driving on the Autobahn, it was fun, but it was really stressful. If you're from Germany or you've ever been there, you probably know. But yeah, it kind of looks a little like this.
This is lovely, isn't it?
Warum fahren wir so langsam? Ich könnte schneller laufen.
Hier ist Baustelle, Papa, wie immer. I thought driving in Germany was going to be really fast and scary. Ah yes, it's the end of the Baustelle. Oh no.
Oh my gosh. All right. In today's video, I want to talk about these two different ETFs. And really the goal here is I want you to think about ETFs in a different way. And I'm going to share with you a few ways that you can do that, because oftentimes when you think about, okay, what is the best dividend ETF, when you Google it or watch a video on it, a lot of what you're going to get is an emotional bias of that person or that article. They're going to say this is the best ETF because it has the lowest expense ratio, or it has a great brand in Vanguard or whatever. Today's video, I'm actually going to educate you using facts and really be objective behind what I'm going to share here in this video. So it's not just my emotions and my opinions. So the main takeaway that I want you to get from this video is I want you to think about ETFs in baskets, right? When you think about a BMW is just another car, right? It gets you from point A to point B. And the way in which you're getting to point A to point B is maybe a little bit different. You have maybe a little bit more luxury and convenience and comfort than maybe, for example, a Honda or a Kia, for example. But at the end of the day, a car is a car. Now, what makes the difference in this car is maybe the reliability, the safety index, and most notably, the engine. That's what makes this individual car so different. And these cars are very similar, and it translates very well into index investing. When you look at it, its surface or the title of the company, they both have dividend appreciation or dividend growth. But when you look under the hood, that's where you're going to see differences in these two ETFs. So this is really important. When you think about an index, you have to understand that the index, the basket of stocks that you're getting with that ETF, is going to vary depending on the methodology and the index that the ETF is based off of, right? You can buy a basket of fruit and you're going to get bananas, you're going to get apples and pears and all of that stuff. If you buy a basket of chocolate or a basket of candy, you're going to get a basket of chocolates. Now, these are very, very different than apples or oranges, right? And then if you go a step further, you can even buy a basket of potatoes, right? All three of these baskets, they serve a different purpose. A basket of potatoes is not going to taste as yummy as a basket of chocolates, but this basket of potatoes or this basket of fruit is going to be maybe more healthier than the basket of chocolates. The thing that you have to understand if you're a new investor, and my channel is all skewed towards new investors, is when you think about an ETF, you have to look under the hood and you have to understand what is the index that this ETF is following. That's the key thing. The brand, the issuer, if it's BlackRock, if it's Schwab, Fidelity, whatever, that doesn't really matter. I mean, it does matter in terms of the expense ratio and a few things, but at the end of the day, the most important thing when you're comparing ETFs is you have to make sure that you understand the basket of what you're purchasing. When I first started learning about dividend investing, I went onto YouTube and I went on Google and I researched best dividend growth ETFs, best dividend stocks, etc. And I would read articles that would show or highlight a few different ETFs and they would give a brief description of what is this ETF. But if you do that here in Google, you're going to see different results, right? And as I mentioned, there's many different baskets. There's many different vehicles, cars with different engines. And it's important that you understand what you're getting when you're investing into a vehicle or an index like what we're seeing here on your screen. You can see some of the best dividend ETFs here, SCHD, VYM, VIG. You might even pull up an article that says the top 3 dividend growth ETFs, right? And you're going to see different content depending on what Google is showing or what Google is promoting at that time. So here in this article, you're going to see an ETF like VIG, you're going to see an ETF like DVY, and also you're going to see an ETF like DGRO. And so the important thing that you understand, as I've been mentioning over and over again here in this video, is understanding what's under the hood when you invest into an ETF. All right, so now let's take a look at under the hood of VIG. So VIG is the Vanguard Dividend Appreciation ETF, and I'm going to read this. This is the most important thing that you understand when you're investing into an ETF is understanding the fund methodology and the index, how it's set up. Okay, so VIG, the way that it's set up is the index is designed to measure the performance of US companies that have followed a policy of consistently increasing dividends every year for at least 10 consecutive years. The index excludes the top 25% of highest yielding eligible companies from the index. So what that means is if you have a company that's paying an incredibly high amount relative to the other companies in the US, it's going to exclude that. This index also excludes REITs and bonds because it's focused only on a qualified dividend. So this is very tax efficient in a taxable account. You're going to get the best possible tax treatment in this ETF. So this is how the Vanguard, the VIG ETF is set up, the fund methodology, and the index, the underlying index behind this ETF. Now let's take a look at the DGRO ETF, the iShares Dividend Growth ETF. This index is focused or based off of the Morningstar US Dividend Growth Index, which is designed to provide exposure to US-based securities with a history of uninterrupted dividend growth. The index is a subset of the Morningstar US Market Index, a broad market index representing 97% of US equity market capitalization. It is a benchmark consisting of securities that pay a qualified dividend, so that means no REITs or no bonds. They are screened for a minimum of 5 years of uninterrupted annual dividend growth, okay? And they have a significant margin to continue growing their dividend. What that means is that the companies in this index do not have a higher payout ratio of 75%. So you're going to exclude utilities in many cases. You're going to exclude a lot of sin stocks. So really, companies that have a lower payout ratio, and this is an indicator for growth. All right, what I want to do next is I want to take a look at VIG and DGRO individually, and I'm going to compare some of the similar, different metrics on each one individually, and then we'll do a side-by-side comparison. All right, so first off, so if you're a do-it-yourself investor, I highly recommend Seeking Alpha. This is where I do all of my research. You have all of the content here in one place. You don't have to have premium, but if you do want to use premium, there is a link in the description below. You can check that out. You can get 50% off your subscription if you use my link. They also have a free trial if you want to try that out, but you don't have to do it. There's the majority of stuff here in Seeking Alpha you can access without premium. Stuff like the grades, you do have to have a premium version for that, but you don't have to have it. You can watch my screen and see how I'm doing it, and you can see the grades while I'm showing the video here. But yeah, the thing that I wanted to show here, if you want to read the fund description, what I just showed there with the fund methodology, this is where you can find that right here on the first summary page. But a couple of things that I want to take a look at. Let's take a look at some of the dividend metrics. This has, with VIG, they have just under a 2% starting dividend yield. They have an 8% dividend growth rate and 12 years of consecutive dividend growth. This is actually really, really good. So when you go in and you take a look at the yield, this is something that's important for me. You know, one of the things that a lot of VIG haters or contrarians have to say why they don't like VIG is the low starting dividend yield. It really has kind of tracked the S&P 500 for the most part. And that's why a lot of, you know, really core dividend investors don't really invest into VIG, is because it's more of like an S&P 500 proxy ETF. Okay. But one of the things that I want to take a look at, this is what's important to me, is what is your yield on cost over time? So the yield on cost is the dividend growth and how that initial investment. So say, for example, you invested $1,000 back in 2017, what would have been the dividend growth, or what would be your initial yield on cost of that initial investment? And that's what I'm really interested in. And so with VIG, it's just over 3%. So not too crazy high. It's not like, massively blowing it out of the park here, but it's okay. It's not really great. When we look at the dividend growth, VIG has been around for a little bit longer. Like we mentioned, they've grown their dividend for 12 consecutive years. The thing that's interesting here is this side right here, the CAGR, the dividend CAGR, back since 2015, seeing the dividend growth since that time period. It's averaged right around between 5 and it looks like 9% is kind of that average of the dividend growth. But on average, if you're dollar cost averaging into this ETF, you can expect anywhere from, 1.75% to 2.5% starting dividend yield if you're dollar cost averaging into VIG. And so just looking at the history once again, 12 years of consistent dividend growth. And one of the other things that I wanted to take a look at was the net inflows. So the net inflows is how popular this ETF is. Are they gaining assets under management, or are people running away from this ETF? Is this an ETF that is popular, that's going to be, where investors are continually parking their money? And yes, I mean, VIG, it does have the Vanguard brand. You are going to see net positive inflows in almost every Vanguard ETF, right? It just holds that Vanguard name. It's just going to be part of the Vanguard family. But this is a very popular ETF. The thing is when this ETF first came out, it was one of the only dividend appreciation ETFs out there, and it was very popular. Today, there's dozens of dividend growth and dividend appreciation ETFs out there in the market, but this was one of the first, and that's why it's as large as it is, because it was one of the first there. So over the last 3 years, the assets under management change, it's seen a net positive of around 78% in assets under management. So that's pretty good. All right, now let's take a look at DGRO, and let's do the exact same thing here. So DGRO is rated a little bit higher for when it comes to the ratings here in Seeking Alpha. They have a little bit of a higher quant rating, and the authors here on Seeking Alpha tend to like DGRO a little bit more. But what I wanted to show you here was the fund profile. Once again, it makes it a little bit easier. You don't have to do all that research that I was just talking about and showing here at the beginning of the video. You have all of that here in the fund profile. You can dive into this and really understand, okay, what are you getting? What is the index? When you lift up the hood and look under the hood, when you're investing in DGRO, what are you actually getting? And this is what you're getting right there. Okay, so let's take a look at some of the metrics here with the dividend. The dividend yield is very, very similar with VIG. Historically, as I've been following DGRO, it's traditionally trading at a higher starting forward yield, which I personally like. And so when we look at the dividend yield, let's do something very similar to what we did before with VIG. Over the last 5 years, if I would have invested $1,000 5 years ago, I get just over 3.34% yield on cost. Now this is a little bit higher than VIG, not significantly higher, but it is higher. Okay, and that's something that's important, right? As a dividend investor, the yield is something that you definitely want to keep an eye on. The dividend growth here, this is what I really like about DGRO, is you're actually getting a higher annual dividend CAGR. The dividend CAGR on DGRO is a little bit higher. Now, this has to do with the nature of where DGRO is invested. It's invested more heavily into technology companies. In the last 10 years, we've been in a bull market, right? So I would be very curious to see what this would look like in a bear market for a longer extended period of time. So unfortunately, we just don't have the history here to analyze this over decades. The same thing with VIG. We just don't have the time, like the decades to look back on and really analyze the extended CAGR, because I hate cherry picking just like 2 or 3 years and be like, all right, guys, this has a 500 million CAGR, like doesn't help anybody, right? The further back you can go, it's a lot more representative and a lot more reliable. And that's, if you're, in statistics, it has a lower standard deviation, all of that stuff. And so that's kind of, food for thought there. All right. So dividend history, it's been paying a dividend for a little bit of a shorter time period. Its inception was 2015 compared to VIG. So it doesn't have the history that the VIG does. The VIG has. When it comes to net inflows, this is the cool thing here. So the assets under management for VIG does have a higher assets under management, and I'll show you that here in just a second when we compare them side by side. But this is the cool thing. DGRO in the last 3 years is just crushing VIG in assets under management growth. You see the net inflows is over 230% here for DGRO. So like what, 3 times that of VIG? It's absolutely incredible. DGRO is crushing VIG in assets under management. So really, really impressive. This is not a small little, dividend growth ETF. This is a big deal. Like this is a big ETF. It's backed by iShares, which is part of BlackRock. It's a really well-known company. And yeah, I mean, you see that here in the assets under management net inflow changes. So let's take a look at the differences here when we're comparing DGRO with VIG. So the way that I did this, you can go in, take a look at the peers, and then it'll show companies or ETFs that are similar of the one that you're reviewing here. All right, so a couple of things. The expense ratio on VIG and DGRO are very similar, right? So VIG is a little bit better. The assets under management are better. It's almost 3 times. VIG almost has 3 times that of DGRO. But if DGRO continues down this path, which I think, what's to stop it? Who knows? I don't have a crystal ball, but I think DGRO is really, really picking up speed, as well as SCHD, by the way, but we'll leave that for another video. Now, this is something you need premium for. So if you want to pause the video, you can take a look at this. If you don't have premium, you can take a look at the Etf Grades, right? You can see the expenses, the dividends. So the dividend for DGRO is less than VIG. I'd be curious why that is. The risk is higher with VIG versus DGRO, and the asset inflows are better with DGRO. So pretty cool stuff. Yeah, you can pause the video if you want to take a look at that or take a screenshot. Let's see, what else do we got? Do we want to show you here? The dividends, when comparing the dividend, DGRO has a higher starting dividend yield. This is the cool thing that I want to show you. This right here is massive. So the 4-year average, if you're dollar cost averaging, which I would say 90% of my viewers are, this is the dividend yield that you can assume over a longer period of time. So if you're dollar cost averaging in a VIG, you're getting just 1 3/4 of a dividend yield. And with DGRO, you're getting 2 1/4. So you're getting 0.5% higher with DGRO. And if you're thinking in the millions, let's do this. Math is hard, so let's use our little calculator here. Let's say you have $1 million, and let's see if I make sure I do that right. Looks like it's right. Some mathematician's going to be like, no, Jake, that's wrong. Well, I think it's right. Let's check. So if you're dollar cost averaging and you have $1 million in these 2 ETFs, you're going to get $2,500 more a year in dividend income, assuming that what we just talked about remains consistent. I don't have a crystal ball, so don't go crazy in the comments. I understand, just take a deep breath. But this is, if we look at it today, the difference between 0.25% for $1 million portfolio. It might seem minuscule, but if you divide that by 12, that's $200 more, a month. I mean, that's probably what Netflix is going to be costing here in the near future with the way inflation's been going. Yeah. Man. Dividend growth, 5-year. VIG 8, DGRO 9. This is what's interesting here. VIG is beating it in the short term here with the pandemic. It's actually almost double VIG. So pretty interesting stuff. They both pay quarterly, all that good stuff. What else do we got here? The performance. So let's look at the 5-year. 5-year, they're like, look at that. Like actually identical. 56.3, 53.45. Let's look at the 3-year. 24.83, 24.98. I mean, they're pretty much like apples and apples. Like they're so similar. Let's see here. Assets under management. We talked about that. Let's see. What else do we got? This is something that's important here. Concentration and risk. So VIG has 292 holdings. DGRO has 422. Okay, and I'll go and I'll take a look at this in just a second and we'll dive into the individual holdings. I'll do that right after this. But you're getting more diversification actually with DGRO. DGRO, you're getting quite a bit more. What that means is you're going to have lower concentration at the top holdings would be my assumption. We'll take a look at that. But you're going to have a longer tail. And what that means is you're going to have more companies in a smaller percentage, and thereby you're diversifying your portfolio or your holdings in that way. So I tend to actually like that. I like more diversification, to be quite honest. I think I personally prefer it. So let's take a look. So when talking about, let's take a look at the individual holdings. So let's go back over here to VIG. Let's look at the sector breakup. You got financials at the highest with VIG, technology at the second, healthcare, industrials. Look at this. This is like perfect for a recession. Financials, technology, healthcare, industrials. Like this is real, well, except for energy. If energy was higher, but you're not going to have a lot in energy. Remember, because it's taking off the top 25% of highest yielding. So you're not going to see a lot of energy in here. Okay, anyways, let's take a look at the top holdings. This is something that I want you to remember is the top percentage, and I'll flip back and forth here. So this is VIG. 29% are in the top 10. You got Johnson & Johnson, Microsoft, United Healthcare, JP Morgan, Procter, Visa, Home Depot, MasterCard, Coca-Cola, Broadcom. I think these are all companies that you probably have heard of, right? I think the majority of us here watching this have probably heard of these companies. Let's take a look at DGRO. DGRO, the holdings here, financials, very similar, healthcare, technology. So fairly similar, actually. A similar breakup in terms of the sector allocation, sector weighting. Now let's take a look at the top holdings. Johnson & Johnson, Microsoft, JP Morgan, Apple, Procter & Gamble, Merck, Coca-Cola, Home Depot, Broadcom, like so similar. And now this is what I wanted you to look at. This is what I was thinking about earlier. 25%, this is DGRO. This is VIG. So VIG 29, going back to DGRO 25. So 4% difference. Not the world, but it still is something. So I thought that was interesting. All right, now let's go use ETF RC. This is the way that you can check for the fund overlap. I definitely recommend this when you're investing in individual ETFs. This is a great way to see where there's overlap. So for example, here when comparing VIG and DGRO, 84% of VIG's holdings are also in DGRO. So massive amounts of overlap. 59% of DGRO's holdings are in VIG. But here's the kicker. This is what you want to focus on here. 67%. There's fund overlap by weight of 67%. So these ETFs are more similar than they're different. And so by that nature, I would recommend, in my opinion, I don't think there's really a need to invest into both. So this is not one of those where I'd say, all right, well, you should invest into both of them because they're both great. No, I don't think that's not the case. These are so similar that I would say, hey, they're so similar, you could just pick one and you'd be okay. Let me use another example of why that's important. So let's compare VIG and VYM. With this, there is 49% overlap in the weighting. So yeah, they're very similar, but they're also fairly different. Let's look at another ETF. Let's look at SCHD. SCHD, this is the kicker here. Look at that. 17% overlap. So that means you could invest into VIG and SCHD and have very, very little overlap. So there would be really a big case to be like, yeah, definitely invest into VIG and SCHD. They're very, very different. Let's do DGRO and SCHD, and let's see the fund overlap, 27%. So you're actually getting more fund overlap with SCHD and with VIG, but there still is enough overlap. There's a quarter overlap with DGRO and SCHD. So I thought that was cool. If you do invest into multiple ETFs, definitely check this out. Because I always get some smarty pants in the comments. Well, why are you investing in so many ETFs? There's always so much fund overlap. Well, I'm like, well, yes, but no. It depends on the ETF, right? In some cases, yes, like with VIG and DGRO. But with this, no. Let me use one more example. Let's use, let's see here. What is another one? VFH. Let's use VFH. This is the Vanguard Financials Sector ETF, right? And let's do VIG. Let's do this. Even the Vanguard Financial and the VIG, there's still a lot of, differences. So if you wanted to invest into a sector ETF, even though the financials sector is the highest weighting in VIG, once again, this is another way of visualizing it. There's really not a lot of sector overlap. Now let's do one last one here. Let's do VOO, right? S&P 500. S&P 500, there's 36% overlap with VIG. So yeah, of course, why wouldn't you want to hold both of them? I mean, I could see a case for that. Let's look at DGRO. DGRO, 48%. So yeah, there is quite a bit of overlap. 48%, yeah, sure. Let's do one last one. I know we're not doing this for the video, but SCHD. So I hear a lot of people, and in the Review My Pies, I see a lot of people invest into VOO and SCHD, and it's like, yes, perfect. Like this is a perfect example of maximizing for dividend growth and growth while getting broad exposure into the stock market. You could have a portfolio of 50% VOO and 50% SCHD, and you'd be kicking butt. You get the best of both worlds. Broad diversification in the S&P 500 and one of the highest quality dividend growth ETFs out there in SCHD. Okay, but I don't want to get off too far on a tangent. What was this? DGRO. We got that. That was 40%. Yeah. All right, now let's take a look at the total return of VIG, S&P 500, and DGRO. And let's take a look at this over time. We could add, well, do you want to add, we'll add SCHD later. So let's take a look. Year to date, they're all down. The best performers, DGRO, the worst performers, the S&P 500. Let's look over the last 3 years. The last 3 years, look at that. S&P 500 doing a little bit better. DGRO doing fairly similar, and VIG. Remember how we just took a look at the fund overlap? The most overlap with the S&P 500 was with DGRO, right? It's about 50%. VIG had significantly less overlap. So you're going to see a difference in total returns with VIG because there's less fund overlap. Hey, you just learned something. All right, let's take a look at 5 years. 5 years, you got 71 for VIG, 71 for S&P 500, and 71 for DGRO. So they're all very, very similar. The case here of, well, you could say, okay, well, Jake, why would you invest into DGRO or VIG versus the S&P 500? And what it really comes down to is the dividend. The dividend is the key thing here. As a dividend investor, you want to live off the dividend, and in early retirement or in retirement, your goal here is to generate generational wealth. You're not selling your shares to pay for your expenses, but rather you're taking the dividends from your portfolio, you're taking them out, and you're paying for your living expenses. And you're letting your shares continue to grow. And as the ETF organically is growing, as the companies, right? Remember, as the individual companies in these baskets, right? Do you remember that? As they continue to grow, they're going to reward you as a shareholder with a growing dividend. Okay, that's the whole thing here. That's the point behind why you invest into VIG or DGRO, and to really take advantage of that snowball effect over decades. And that's how you build generational wealth, or at least one way that you could build generational wealth. Let's take a look at another one here. This is with SCHD. You need the premium version to be able to do this, but if you want to just watch me do it, that's cool. Let's see here. What do we got? Which one's the highest performer? Look at that. My favorite dividend growth ETF is beating all three of them over the last 5 years, right? And this is with the total return, so the dividend income and all that jazz. So pretty cool stuff. Well, everybody, thank you so much for watching. I hope that this was helpful. Really, the point of this was to help you understand the different baskets. When you're comparing ETFs, don't look at the brand, don't look at the title of the ETF, look at the index. What is the index that you're getting when you invest into that ETF? That's the key thing here. And when you're a new investor, you don't really understand that. Okay, but now all of you having watched this video, you're one bit smarter. I hope that this was helpful. Thank you so much for watching, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.